Welcome back. You're watching Startup Central with me, Nayantara, working from home. This is the only show of its kind in Indian television dedicated to startups. Of course, technology, innovation, disruption. If it's under the new economy, it's here every weekday at 6 p.m. Ladies and gentlemen, founders, startups, pay attention. Are you running out of cash? Have you been able to increase your cash runway? Are you been able to find an antidote for COVID-19? Well, in case you haven't, here is one more solution. Is it worth your while? Is it something you should even consider? And I'm talking about debt. TiE Delhi NCR has talked about debt capital as one of the options to survive, to increase the runway, make it on the other side of COVID-19, and then also grow the business. I'm going to be discussing that and a lot more with Saurabh Srivastava. You know him very well as Alok Mittal from Indifi. Gentlemen, thank you so much for joining us on this edition of Startup Central. I know this is a project very close to both your hearts, and how you both have spent a considerable time of the lockdown and the unlock phase to help startups reimagine their balance sheet, reimagine their businesses, reimagine survival. Mr. Srivastava, Dr. Srivastava, I'll come to you first.
Okay.
You know, a lot of people say, is debt ever a good idea? You know, when you are almost on the verge of collapse, and a lot of startups have been, we only celebrate the successes, but you know, there are always failures. There are far more failures than a success story. Is debt something that founders should even look at?
So, Nayantara, debt is actually not just a good idea, it's a brilliant idea if you have the cash flow to pay it back. Because debt does not dilute your equity. So debt is a much cheaper form of capital than equity. However, if you're a startup which doesn't have revenues, doesn't have cash flows, you better stay with equity. So the idea of debt in these times came up and just from a TiE perspective. What we're trying to do is help entrepreneurs by mentoring them, by giving them access to the networks of the charter members, helping them businesses in their businesses in every single way. And one of the key elements is helping them get ready and be able to get financing. Now, equity financing is normally what happens, what we're good at. But at this time, raising equity is not a brilliant idea for startups because the valuations are down. There's less money on the table for equity, and therefore, inevitably, they would dilute more than they needed to. So debt actually right now is a very good idea. And that is how Alok came up with this idea of a product, the leading company on online lending. And then Alok Mittal and TiE, we all sort of said, look, why don't we actually offer it to all the TiE members, all the TiE startups? And the financing would come from Indifi, and Alok will talk about that. And at TiE, what we will do is we'll mentor the company, help the company, give them access to networks, make sure that they do work well and succeed. And so it's good for TiE, helping our startups, good for Indifi, because we'll probably try and help and increase the company's chance of success. So the last word I would say on this is, this debt is not a bailout package from the government. This is debt which will expect a return because Indifi, which is Alok, is giving this debt and the money it's raised from investors who expect a return. But it's a very, very smartly crafted product which will go to companies that actually need money to scale, to diversify, that are otherwise successful, that are otherwise doing well, but would not have been able to grow, would not have been able to diversify their ranges if they didn't have money. And equity money is very expensive for them right now. And that is why debt is the ideal form for them. So I would say this is exactly the right time for startups to look at debt of the kind that is being put together by Indifi, because it is not meant for every company, but those companies that can avail of it, it is better to take that than take equity.
Right, sir. Okay, so now you've heard Dr. Saurabh Srivastava there explaining to you when you should take debt, the kind of startups that should even consider debt in the first place. Now let me go across to the person in charge of providing that debt. This is of course your business. This is what Indifi does. It's in the lending space. I want to understand why you're doing this. There's always a catch. There's something in businesses, there's no free lunch, right? So if I look at Indifi, I'm sure you're also having to anyway tackle with higher delinquencies. There's the RBI moratorium that I don't know how much of your loan book has decided to opt for. And now you're providing loans to startups saying we don't want collateral. The repayment will be in up to 36 months. It's a short-term loan. So my first question is, Alok Mittal, is this a very expensive loan? It may be cheaper than equity, but is it still a far more expensive loan that what could be availed of from a commercial bank, but maybe the commercial bank wouldn't give these startups loans?
Absolutely, you're right. So this loan will be more expensive than what commercial banks would lend, but unfortunately, they would not lend to the same startups who need this financing. I think that at the center of the question is, what are we doing in the product that makes it viable for us to lend, right? The reason commercial banks don't lend to this segment is because they anticipate very high losses, right? Not because their capital is expensive. And that is where the product design comes in. What we have done is, given all of the experience that we've had and TAI has had, we have come up with a segment of startups where we think this is actually viable both for the startup and for us as a lender. And that segment is where entrepreneurs have figured out the unit margins on their marketing investments, right? So they invest 100 rupees in marketing today. They know that 6 months down the line, that 100 rupees gives them back 200 rupees in revenue. And this is the cash conversion cycle that we are looking to finance. So this is not a survival runway extension product for startups. It's a growth product for startups. And startups that have figured out that growth cycle are the ones that will benefit from it. And from our standpoint, those are the startups that we are looking to fund through this loan because we have relatively high confidence that those startups will be able to service this debt and return the money with the interest on it.
So can you give me a little idea of the kind of disbursals and disbursements you have made since the launch of this product, Debt Capital for Startups? Has it taken off? What kind of disbursements are we talking about?
We launched this product in May and then towards the end of May, early June with TAI. We have seen over 100 startups apply for this product. We have already sanctioned loans worth a few crores to about a dozen startups from those, and more of those startups are in the pipeline. So from a response standpoint, we have seen a great response from startups who would otherwise have no access to capital in these times, come in and try to tap into this. As I said, this product is intended for a specific set of startups which have this positive cash conversion cycle. And so those are the startups that we are screening out. This is not a product where we look at the monthly credits and debits, and because the business is profitable, there is an automatic qualification. So we bring in the understanding of how startups operate, what do their financial statements look like, how to spot this positive cash conversion cycle, and factor in the mentoring that is going to come from TAI to make sure they stay on this plan to be able to underwrite. So it's a fairly engaged underwriting process that startups have to go through. And I'm glad to say that more than 100 startups have raised their hands and said this is the right product for us.
More than 100 startups have approached Indifi for loans. These are collateral-free loans. You must be cash flow positive as well. And then TAI Delhi is there to mentor you. So let me go back to Saurabh Srivastava. This is what he's done. This is what he's famous for, the right advice. So Saurabh Srivastava, when you have been advising startups, it must have been a struggle. You've had to make them relook at their babies, relook at their vision, reimagine it all. And it is very, very challenging. I want to revisit my question with you as well. At least when you pick up equity, which is far more expensive, wouldn't it be a case of sleeping better at night, knowing that, okay, if things don't go as per plan, at least you know, those who have invested have equity, and it's fine. But if you take that loan to have a person chasing you for repayment of loans, isn't that far more scary at a time like this? A lot of the founders are very, very young. They're just barely out of college. Many of them are older, have put their entire life savings on, and aren't they going to be more troubled at night with the idea that they have to pay back an NBFC at a rate which, you know, is maybe cheaper than equity but more expensive than a bank?
So Nayantara, actually, startup founders actually never sleep easy at night anyway. They've always got something to worry about. If it's not money, it's about an order, it's about a product that's delayed. There's always something. So it's not about sleeping easy. But you're right. I think, as Alok said, this is not a product for everybody. So I think whether you're taking debt or you're taking equity, you really shouldn't take it lightly, because in the case of equity, you're giving up a part of the company, and you better be sure you want that amount of money to give up a part of your company. But if you're taking debt, then at least the equity investor understands that they may lose it all, and they have the margins to allow for that. I mean, a VC invests in 20 companies, and it expects half of them might fail. So they budget for it. In debt, they have less margin for error. So debt has to be much tighter. And therefore, if you're taking debt, you should be fairly sure that you have the ability to repay the capital and the interest. So certainly you shouldn't take debt if you are not reasonably certain. Having said that, it's not as if failures do not happen even in debt. You might. But remember, this is a debt which doesn't have collateral. So it's not as if Alok Mittal would have mortgaged your house. You're not going to lose your house. So it's not the kind of debt that comes with the kind of collateral that normal bank debt would come. But yes, failure still has sort of results. And therefore, if you're not able to repay the debt, there will always be some penalties associated with it. So to answer your question, I don't think it should be taken lightly. People should do their own mathematics. Certainly, the team at Indifi will go through everything with a tooth comb, because they really don't want a failure. But I think the startup founder needs to do their own analysis. And if they can meet those conditions,
Okay.
I think it's a good idea at this time, because it is a cheaper option than taking equity at this time. But like everything in life, there's always life, there's always two sides to a coin. So you take debt, you should be planning to pay it back. Although I would say in a very different way that if you ask the best entrepreneurs, they will tell you that when they took equity, they had every intention that they should be able to pay back a multiple of it to the investors. So they take equity as seriously as, people take debts. I mean, I don't know if that answers your question.
Okay, so with that, having said that, Saurabh Srivastava, no, it does. It really does. And I'm going to make this my final question, and very, very quickly, Alok, because my producer is telling me we have to take a short commercial break. So debt is a better shot than equity. But tell me something which we have not discussed. What rate are you charging? And very quickly, please, since we're running out of time.
So Nayantara, I don't think this is the question of whether debt is better than equity or not. A lot of this is about what is available at a point in time. And one of the things that we have done is, because we realize that these are times of COVID, and hence there is inherent volatility in business, we have actually innovated with some of the flexible repayment structures. So our repayments in many of these cases are tied to the amount of revenue that the startup generates in a month, which means that within a band, we can live with the volatility. If the revenue is lower in a certain month, then we will get repaid less in a given month, and we can be repaid over a longer period of time. And if the revenues go up and the entrepreneurs can repay us faster, then they can repay us faster and settle the loan earlier, right? So these are what are called revenue-based finance loan, where there is a linkage to the revenue. So it doesn't mean that if for 3 months the revenue is low, then the startup still has to service our loan at a fixed EMI rate.
Okay. Okay. So that's interesting that, like what you sometimes seen in commercial real estate, how it's all linked and you have those revenue linked schemes that you share with the landlord, something similar and a new innovation that's coming out. Ladies and gentlemen, if you're interested, I guess you can reach out to Thai Delhi and Indifi. I'm sure there are others who are also trying to come up with similar products where Startup Central will hunt them out for you as well. For now, we'll take a short commercial break. I'd like to thank both my guests for joining us live, but stay tuned. On the other side, we're going to touch base with IIT Delhi, which has developed the world's cheapest COVID test. Stay tuned.